Welcome back to the deep dive. Today we're strapping in, really digging into what happened during that, well, brutal 48 hours back on October 10th and 11th, 2025.
Yeah, the crypto flash crash.
Yeah.
It honestly felt like the whole market was hitting the eject button.
It really did. And this wasn't just, a typical market dip.
No, not at all. Our sources are pretty clear. This was, historically speaking, the biggest single-day liquidation event ever in crypto. We're talking over $19 billion in positions just gone, vanished.
19 billion. Let's just sit with that number for a second. Because the scale, it's almost hard to really picture. Bitcoin took a massive hit, right?
Oh, yeah. It plunged, about 15%? Yeah. Dropped from around $122,500 down to near $104,000. Incredibly fast.
And Ethereum.
Ethereum got hammered, too, down 21%. And altcoins. Forget about it. Some of them just evaporated down 50, 60, even 80% in some cases.
Wow. So when the dust finally started to settle.
The total crypto market cap had lost almost $1 trillion. $1 trillion in just 24 hours. For so many people involved, it was just devastating.
Absolutely. So the core mission for us today, as we look through all this source material, is trying to unravel this puzzle. Was this whole thing just, bad market mechanics, over-leveraged positions, maybe some exchange glitches?
Was there something else? Was it maybe the quote-unquote invisible hand of the U.S. government pulling strings, policy changes, regulatory gaps, basically external shocks?
Okay, let's start there then. Because the policy situation in early October really seems like it set the stage, didn't it? Created this perfect storm waiting to happen.
It really did. We've identified two key government actions that acted like the fuse on a bomb.
The first one being the government shutdown.
Exactly. It officially kicked off October 1st. Now, this was the first full shutdown we'd seen since 2019. And, while Wall Street sometimes just shrugs these things off.
Crypto's different, isn't it? It relies so much more on regulatory momentum, institutional frameworks being built out.
Precisely. So this shutdown, it was like putting a blindfold on the market. Key agencies, the SEC, the CFTC, they just went dark. No guidance, no approvals, nothing.
So zero communication. And that had a direct impact, right? Especially on those anticipated ETFs.
Well, absolutely critical impact. There were 16, count them, 16 pending spot crypto ETFs. For big names, too, like Solana, Litecoin, they were just stuck in limbo.
Their deadlines just vanished.
Poof.
Yeah.
Gone. Replaced by just silence, regulatory silence. And that immediately kills institutional buzz, right?
Yeah, because if big funds can't get a clear timeline for launching new products, they're going to hold back their capital.
Exactly. So you've got this potential multi-billion-dollar flow of new money just turned off because of a domestic political fight that instantly creates this sense of dread, this liquidity worry.
The market basically read it as Washington saying crypto wasn't essential.
Pretty much. Or at least that the regulatory path was totally stalled. That breeds anxiety, and it definitely starved liquidity.
Okay, so that's the blindfold, the uncertainty. Then came the match, October 10th. President Trump drops a bombshell.
A huge one. And timed, just as markets were getting thin for the weekend, he threatened 100% tariffs on all Chinese goods.
100%. That sounds extreme.
It was seen as taking the trade war to nuclear levels, as some analysts put it. Instantly triggered a massive global risk-off reaction.
Okay, but hold on. Tariffs on Chinese goods. Why did crypto react so violently? That sounds more like a traditional market manufacturing kind of issue.
Well, because big tariffs like that signal immediate friction, major supply chain problems, economic slowdown. And that makes everyone, especially big institutions, run from anything they see as risky.
And crypto, despite its size now, is still treated as a high-risk asset by a lot of traditional money.
Exactly. It's high beta. We saw it ripple through traditional markets too, didn't we? The NASDAQ dropped over 3.5%. S&P 500 had its worst day since April.
So crypto just felt that panic even harder, even faster.
Yeah, it's like the most sensitive canary in the coal mine for global jitters. So you put it together. The shutdown created this regulatory void and liquidity issue. The tariff threat was the shock that lit the fuse.
But even then, $19 billion liquidated. That fast. That still feels like there has to be more to the story. Like the market itself was already on shaky ground.
Oh, it absolutely was. And that brings us to the amplifiers. How does a tweet, even a big one, cause $19 billion to just vaporize almost instantly?
Yeah, what was the mechanism there?
Leverage. Pure and simple. The market was drunk on leverage. There was so much euphoria, especially with Bitcoin pushing toward, 120K. People were taking insane risks.
What kind of leverage are we talking?
Derivatives markets were completely overextended. You had traders using 50x, 100x, sometimes even more, just betting prices would keep going up. billions in long positions built on borrowed money.
Okay, so super fragile. Then the tariff news hits, causes maybe a small initial price drop, and then the dominoes fall.
Exactly. Their first small dip was the trigger.
Uh-huh.
Because when you're that leveraged, even a tiny price drop forces you to add more collateral and boom, automatic liquidation.
So the system just starts selling.
The exchange systems automatically start force selling those long positions to cover the debts. That selling pushes the price down more, which then triggers the next level of liquidations below that price.
The classic leverage cascade.
Textbook example. And that $19 billion total liquidation, the vast majority, like $16.7 billion, was those longs getting wiped out. Bitcoin and Ethereum longs alone accounted for over $2.6 billion of that.
It's market structure basically weaponizing panic. But wasn't there also technical chaos adding fuel to this fire? Glitches, stablecoin issues?
Yeah, there were definitely technical factors amplifying the panic. First, you had a bit of a stablecoin wobble. Athena's USDD, it briefly dipped just fractionally below $1.
Which doesn't sound like much, but in stablecoin land.
It's enough to freak people out. Even a tiny depeg makes algorithms and traders think the bedrock, the dollar peg, is shaking. That causes an immediate rush for the exits, just in case.
And then issues with the exchanges themselves, people seeing crazy prices.
Right. There were reports of display issues on some platforms, altcoins flashing 0 or near 0 on screen, even if the actual price feeds may be held up elsewhere. When prices move that fast, and then the data you're seeing looks broken,
confidence just evaporates.
Completely. And add to that, API failures. Market makers rely on APIs to update their buy and sell orders constantly. When those APIs fail under stress,
they can't reliably price anything.
So they pull their bids, they just step back. And that removes crucial buying support, that floor, right when the market is in free fall. It turns a dip into a potential death spiral.
So the efficiency that normally helps the market turns into fragility under pressure. And of course, you always hear whispers after these things. Manipulation, whales making moves.
Always. And sources do point to pretty strong rumors of coordinated whale action. We're talking potentially over $1 billion in short positions being opened just before Trump's tariff tweet hit.
Timing it perfectly with a predictable shock.
Well, proving intent is always hard right after the fact, but yeah, the timing looks convenient, let's say. It suggests some sophisticated players might have been anticipating or maybe even helping nudge the reaction.
Which all brings us back to the environment that allowed this kind of instability, that regulatory gray area.
We need to talk about this sort of dual policy paradox you mentioned.
Yeah, it's a really interesting conflict because on one side, you had the Trump administration in 2025 being, on the surface, very pro-crypto.
Right, banning CBDCs, the Genius Act, trying to set up a federal framework, even talk of a strategic Bitcoin reserve. That all sounds positive.
It does. It signals a certain level of political acceptance, even encouragement. But then you have the other side.
The critics, people like Senators Warren and Waters.
Exactly. They were very vocal, calling the administration's whole approach a massive conflict of interest. They pointed to things like the Trump family's known crypto holdings and profits.
The Trumpy meme coins. Yeah, that whole situation. And also the kind of mysterious halt to an SEC investigation involving a major crypto figure, Justin Sun. Whether founded or not, these things create a perception issue.
So you have this weird mix, pro-crypto rhetoric, but alongside regulatory chaos and questions about potential self-interest.
And the government shutdown just made that chaos worse, didn't it?
Huh.
Because it delayed those crucial market structure bills that were supposed to clarify who oversees what, the SEC or the CFTC.
Leaving crypto stuck in this regulatory no man's land.
Precisely. A gray area. And what thrives in regulatory gray areas with weak enforcement?
Illicit activity. Wash trading.
You got it. Sources showed wash trading numbers spiking like $2.57 billion in 2025. And things like ransomware payments using crypto reportedly increased during that policy vacuum, too. So the lack of clear rules, maybe meant to foster innovation, actually created this huge vulnerability that the crash just rips wide open.
Okay, let's try and pull this all together then. Synthesizing the blame. Looking back at October 10th and 11th, what's the final verdict from the source material? What really happened?
I mean, ultimately, the crash itself is a perfect storm, right? It was the internal market sin of just way too much leverage.
Greed getting out of hand.
Yeah, amplified by the usual thinness of weekend liquidity. And then these technical glitches, the API failures, the display issues, that turned a bad situation into a total rout.
But the government's actions were the catalysts.
Absolutely essential in setting the stage. We have to be clear about their role. The shutdown wasn't the direct cause of the crash, but it acted like the blindfold.
How so?
It robbed the market of its forward vision. Traders, institutions. They were flying blind without key signals, especially those expected ETF approvals. It created anxiety. It thinned out liquidity even more.
Okay, shutdown is the blindfold. And the tariff tweet.
That was the match. That lit the whole tinderbox of excessive leverage. It sparked those immediate visceral fears of a global trade war, supply chain chaos, the universal sell risky stuff now signal.
And as that analyst put it on X, no currency escapes macro forces or government manipulation.
Even Bitcoin. That's the hard lesson here, especially for an ecosystem built on the idea of escaping exactly that.
Yeah, it's a tough pill to swallow. But, importantly, the analysis seems to be calling this more of a purge than a fundamental break, right?
Yes, very much so. A purge of excess leverage. It was painful, yes, but it arguably cleaned out the unsustainable froth. The weak hands, the over-leveraged gamblers, they got forced out.
And this might be the most crucial point, maybe the core bullish takeaway here. Despite all that chaos, despite government policy being frozen, the actual network kept working.
That's the anti-fragility concept right there. While DC was shut down and fiat-based markets were melting, the Bitcoin blockchain itself just kept chugging along. Blocks were mined, transactions were confirmed without interruption.
Washington's chaos couldn't cut that decentralized cord.
Exactly. So the crash brutally exposed how vulnerable the price of crypto is to U.S. policy games, how it gets treated like a pawn. But the underlying technology, it passed a massive stress test.
It proved the decentralized infrastructure works, even if the layer where price is discovered is still easily swayed by these big macro events.
A very painful, but maybe necessary system check.
Okay, so that brings us to our final section, the outlook. As of Monday, October 13th, just after the crash, rebound or reckoning? Where do things stand?
Well, by that Monday, there were definite signs of stabilization. The market was trying to find its footing. Bitcoin managed to climb back over $115,000. Ethereum jumped, 11%? Liquidity started trickling back in.
And the bullish narrative started forming pretty quickly, didn't it?
Yeah, the whisper was that the institutional money, the smart money, hadn't really panicked. We were still seeing data suggesting ETF inflows hit around $5.9 billion, even during the worst of it.
So the bull case really hangs on the shutdown ending soon?
Almost entirely. The thinking is, once Washington reopens, those 16 frozen ETFs get unlocked pretty fast. That means billions in potential inflows and a huge restoration of regulatory confidence.
Plus, maybe a silver lining from the shutdown itself.
Potentially. Some analysts were speculating that furloughing workers might lead to slightly softer economic data, maybe nudging the Fed towards thinking about rate cuts later in the year. That would obviously fuel more institutional interest.
And you had those super bullish calls reappearing, eyeing Bitcoin at $225,000 by year-end, arguing the crash just cleared out the deadwood.
Definitely. But you have to balance that with the bear case, which is still very real and, again, tied directly to policy risk.
What are the main threats lingering?
Well, first, what if the shutdown doesn't end quickly? If it drags on for weeks, that regulatory fog just gets thicker and thicker, continuing to suppress liquidity and confidence.
And the fight over stablecoins.
That's a big one. You've got intense lobbying from traditional banks trying to crack down on stablecoin yields.
Yeah.
If they succeed, that hits a core crypto use case pretty hard.
And then there's just the lingering fear of another tweet, another sudden policy shock.
Exactly. The market proved just how sensitive it is to that kind of geopolitical saber-rattling. That risk hasn't gone away. And don't forget the illicit finance angle.
Because the activity spiked during the policy gap.
Right. That just gives regulators more ammunition to come in heavy later on, trying to close those loopholes.
Yeah.
So the volatility, the policy uncertainty, it's definitely still there.
Okay, so let's wrap this deep dive up. The October crash, it seems, was this really painful meeting point between the market's own excesses, primarily that massive leverage, and the instability injected by external politics.
Yeah, the U.S. government, with that combination of the shutdown blindfold and the tariff match, showed it can absolutely pull the rug out from under the market, trigger a huge cascade.
But crucially, while they can influence the macro environment, maybe manipulate the price.
They couldn't break the core technology. The decentralized network itself proved resilient. Blocks kept getting mined. The market started to heal itself almost as soon as the immediate panic eased.
Which leads us to our final thought for you, the listener, to consider. We know the crypto market has weathered other massive storms, FTX, Luna, the COVID crash. The network's resilience seems proven in that sense. But the vulnerability clearly lies at that intersection with government policy and regulation. So the question is, what responsibility does the crypto community itself have? How much effort needs to go into pushing for clear, transparent rules, like getting those market structure bills passed so that this kind of policy chaos, this regulatory gray area, doesn't keep being the trigger for the next big blow up?
Yeah, I mean, you can have the most decentralized tech in the world, but if the on-ramps and off-ramps, the places where it meets the traditional world, are subject to these chaotic political whims, that remains a huge vulnerability. That seems like the challenge now.
Definitely food for thought. Thanks for joining us for this deep dive. We'll catch you next time.